Right now is not a good time to invest in equities, and this is because of the obvious reasons that the markets are not doing very well. So many companies that are trading in equities are currently giving their clients yields in the negative. But this advice is not meant for everyone. And I would like to break it down in two different types of people. One who already has some money and another one who is starting out. Those who are starting out, please stay with me a little bit while I address those with some money already. I'm sure you're going to also learn something from this. But in the meantime, please press that like button down there. This tells YouTube to spread this video even further to me reach many more with this information. And if you haven't subscribed, please do and join the conversation. So if you're not new to investment and you have probably made some money already and you're in the place you're thinking of ways to invest this year, then it is the best time to buy equities. This includes those who are already looking at their statements and they seem like they are making losses. If you have more money to invest, do not rush to sell whatever you already have because you will make a loss. Remember, in investing, a loss is not a loss until you sell. So the best way to go around this is to buy more shares and you will thank me later. This is simply because most of the equities that we're seeing around are currently at a low price, and when we look back into history, or rather past performance, what we learn is that the best time to buy equities or shares is when everyone is scared. I learned this secret from Warren Buffett, the investment guru, where he said that when it comes to investment 101, be scared when people are greedy and be greedy when people are scared. What do you think about this concept? Do you have the guts to follow it? You can let me know in the comment section below. Well, this can work in so many other areas in life. Whenever people are greedy, they hold on to what they have. They want you to pay so much for the same thing. They are not desperate, but when people are scared, all they think about is survival. They really don't care how much they're going to make out of something. They just want to survive. They want to rescue whatever they can rescue. This is a very wrong way to get into investment. And if by any chance you are one of these scared people, when it comes to investment, then I think the next advice belongs to you. This applies to both those with money but are scared and those who are starting out in the investment journey today. The good news is that whenever equities or shares are doing terribly, in most instances, the less risky options are doing fairly well. And the same applies to the vice versa. Therefore, whenever things are not doing very well in the market, then it's time to consider putting your money in the less risky investment options such as money market funds, treasury bills, or fixed deposits. But in the instance that you cannot find a good bargain for your fixed deposits, considering that they always prefer giving better returns to people with so much money, and when you come with little money, they look at you as a nobody, then there's always a way to beat that. It's no secret that when you go to a bank, for instance, and you have 100,000, the kind of eye attention that you're going to get will not be on the same level with someone that came to the bank with 100 million. For that reason, somewhere along the line, smart people decided to come up with a plan to ensure that they combine their forces and bring their little monies together. And then the fund manager goes to the same bank and negotiates for a better interest rate with all the money put together. And once they get a better interest rate, the good returns are distributed equitably to all the members who pull their resources together. What I just described right there is how you can invest in unit trust and how they work. The money market funds are part of this unit trust. The other term we use to refer to the money markets is a safe parking zone for money. And just as the name goes, this simply means that whenever there is turmoil everywhere else, please bring back your money to the safe zone. So majority of the banks right now which are offering fixed deposit accounts are giving anything between 5% to 7%. But of course, there could be an exception of some of the small banks giving a better rate. But on the other hand, majority of the money market funds are now giving an interest rate of above 9%. Some are even giving something above 10%. But it is important to note that money market funds are not a long-term investment option. But still, compared to several other long-term investment options, there are times that they will give you a better option or alternative to investment. And just because your great grandparents and your grandparents and your parents and all of them adopted to go for the fixed deposit account, that does not mean that it is the best or the only place that you can invest your money. In short, when the markets are doing very bad and you still have some money, or what I prefer calling disposable money, then the best bet for you is to buy more, invest more. But when you're starting out and when you have a problem with risk, or rather have a low risk appetite, then you should consider putting your money in products that give you a lower risk and will always try to preserve your capital. This is Moneyversations. If it is all about making money, business, or investment, then it's the conversation we'll definitely have. See you in the next video.